Welcome back to the deep dive. You know, when you sit down to tackle your financial planning, you do all the usual stuff. You look at your investments, your budget, maybe review your will. But there's this one thing, this one piece that most people just dread, and they often skip it entirely.
Assessing the insurance policies they already have?
Exactly. They just assume, it's good enough. But that assumption, that can be the most dangerous financial vulnerability you have. So today we're putting a stop to that. We're not here to sell you anything. We're going to dive deep into assessing your existing life insurance portfolio, the individual policies, your group coverage from work, and even the government benefits you might get. Okay, let's unpack this.
And the real power of this deep dive is that we're essentially giving you the expert's toolkit. Our sources are pulled straight from professional assessment guidelines. I mean, this is literally the checklist a life agent uses before they even think about recommending a new policy. We're repurposing it for you so you can critically evaluate your own coverage and spot those hidden risks.
Our mission today is pretty systematic. We're hitting three key areas. First, decoding the fine print of your individual contracts. Second, we'll expose the risks in your workplace and government benefits. And finally, we'll get into quantifying what your family actually needs financially to make sure your coverage is aiming for the right target.
All right, let's jump straight into the contract you actually control your individual policies. This is where we really sort the renters from the owners, so to speak.
Yeah.
Because the policy type, it determines everything about cost and whether you have accessible money inside the policy. Yeah, that's the first step. Identification. Is it term insurance? You know, the simple kind that ends after a set period, like renting? Or is it permanent, like whole life or universal life, which is more like owning an asset that builds equity?
Knowing which bucket it falls into dictates everything else.
And if you have one of those permanent policies, the fine print is absolutely critical. Take a participating whole life policy, for example. How are your dividends being used? Are you just taking them as cash? Because if you are, you're sacrificing tax-free growth. What you really want to see is that they're being used for something called paid-up additions, or PUA.
PUA. Okay, that sounds like a tiny bookkeeping detail. Why is that feature so crucial?
Because PUA is this hidden compounding growth engine. When a dividend buys a PUA, it's buying a tiny, fully paid-for piece of additional insurance.
Okay.
And this little addition, it increases your total death benefit, and it increases the guaranteed cash value of your policy. It's powerful tax-sheltered compounding over decades.
Right. And if you're taking cash instead, you're just leaving all that growth on the table. Let's connect this to a really common trap, the term policy renewal. We've got the case of Derek. He bought a 10-year term policy, $250,000 when his son was young. His premium now is cheap, just $250 a year. But the fine print forces us to look at renewability, right? When does it end? And until what age can it be converted without a medical exam?
And the cost explosion on renewal is the real problem here. Derek's rate at age 49 jumps to over $1,000. By age 69, that $250 premium, it's ballooned to almost $7,000 a year.
Wow.
For many people, that's just financially unsustainable. So they risk dropping the policy right when they might need it most.
That brings us to cash value, the CSV, in permanent policies. If I have a whole life or UL policy, I need to know the cash surrender value and the adjusted cost basis, or ACB. Why do I care about that ACB number? Taxes. That's why. Think of the ACB as what you've paid in, your basis. If you borrow against the cash value or you surrender the policy, any money you get that's above your ACB is a taxable gain. I see. So if you don't track it, you could get a surprise tax bill.
A huge one. It can shift from being an asset to a major tax liability if you don't understand it.
We also need to confirm who owns it, an individual, a corporation, and if it's a joint first to die versus a joint last to die policy.
All details that affect estate planning. And then there are the riders. The Guaranteed Insurability Benefit, or GIB, that rider is priceless. It lets you buy more coverage in the future with no medical questions asked. So if you get sick, that GIB might be the only way you can ever increase your coverage again.
Okay, and finally, exclusions. Derek's policy had a double indemnity rider.
Right, so it pays out double if he dies by accident.
But the catch is those often exclude death from natural causes. The biggest detail we found in Derek's policy, though, was the beneficiary. He'd changed it from his ex-wife Susan to his estate.
And that sounds like a small administrative change.
But what does it mean?
It means that $250,000 payout is now subject to probate fees and creditors. It completely undermines his original goal of getting money to his family quickly and privately. So we've covered the policies you control. Let's talk about the ones where that control is. Well, It's an illusion.
Mhm.
The coverage tied to your business or your job.
Right.
For business owners, the checklist for a buy-sell agreement is just fundamental.
So the insurance is basically the funding mechanism. The agreement says when a partner dies, the others have to buy out their share.
And the policy makes sure the cash is there to do it instantly.
Wait a second, if standard term insurance is so much cheaper, why would a business ever use permanent insurance for a buy-sell? Isn't that overkill?
That's a great question. And term is often used for, temporary needs, collateral for a bank loan or a simple crisscross agreement to keep costs down. But permanent insurance is often preferred if the company wants to use the policy's tax-deferred cash value before someone dies. Maybe to buy out a retiring owner, for example. It serves multiple goals, not just the death benefit.
And for key employees, there's the split dollar arrangement.
A really elegant solution. The business owns the death benefit, the protection, and the employee owns the cash value, which acts like a tax-deferred investment. It keeps everyone happy.
Okay, let's turn to group insurance. This is where the vulnerability is highest, right?
It is. This is where we see the most planning errors. And the crucial insight is this. The group plan member is not the policyholder.
The employer is.
The employer is,
Yeah.
or the association.
So you have basically no control. Your employer can terminate the contract, switch providers, change the benefits, all without your consent.
And that lack of control is terrifying, especially if your health declines. We hear stories all the time. Someone gets a difficult diagnosis, they lose their job, and their group coverage just vanishes on their last day. Now they're uninsurable.
Which is why the convertibility option is probably the single most important feature to look for in a group policy. It's your lifeline.
Absolutely. The CLHIA guidelines suggest you should have the option to convert up to $200,000 of that coverage into an individual term policy. And this is critical without providing proof of insurability. You usually have about 31 days after you leave.
And that window is your only shot if your health has changed.
It is. The amounts can vary, like in Quebec it can be higher, but the principle is the same.
So for Derek, his policy is 1x his annual salary, and it is convertible. That's good.
A decent feature, yeah.
Oh.
But it still means his total guaranteed individual coverage is just that $250,000 term policy plus whatever 1x his salary is. It's probably not enough.
Which is why we have to do the needs analysis.
Yes.
Let's quickly review the foundational layer, government survivor benefits. And we have to stress these are small complements, not substitutes for proper coverage.
Right. They help, but they won't cover the mortgage.
So with the Canada Pension Plan, you have CPP survivor benefits.
And first rule, you have to apply. It is not automatic. The lump sum death benefit is modest, capped at $2,500.
Which barely covers a modern funeral.
Barely. The main monthly support is the survivor's pension. For 2024, the max is around $740 a month if the survivor is under 65.
And there's also a children's benefit.
Yeah, about $294 monthly for each dependent child up to age 25 if they're a full-time student. Again, it helps, but it's not child care funding.
What's the key difference with the Quebec Pension Plan, the QPP?
It's a small but vital distinction. The QPP death benefit, also capped at $2,500, is only paid to the extent of funeral expenses actually incurred.
Oh. So if the funeral was prepaid, the family might not get anything.
Exactly. They might not get the benefit at all.
And then there's the old age security allowance for the survivor. This one is very narrowly targeted, isn't it?
Extremely narrow. It's for low-income surviving spouses between 60 and 64. If the survivor's income is above about $29,000, the allowance is eliminated completely. You can't bank on it.
Okay, and last one, workers' compensation. Let's just underline the big limitation here.
The limitation is absolute. WC benefits are only payable if death is from a work-related accident or illness.
A heart attack on the weekend.
Zero WC benefits. So it's important coverage, but it can't be relied upon for your general life insurance needs. So we've covered existing assets policies, government benefits. Now we have to transition to quantifying the required needs. And the big shift here philosophically is realizing that life insurance isn't for the insured. It's based entirely on the financial needs of the dependents.
So we start with the family lifestyle deep dive. This is where we put a price tag on peace of mind, like the childcare strategy. If you're gone, does your spouse have to go back to work immediately? Or can the policy fund some time off?
Exactly. And if care is needed, are we funding subsidized daycare or a full-time nanny? Those are vastly different numbers. And spousal dependency. How long will that support be needed? Is it until their retirement? Or is it funding, say, a 2-year transition for education or training so they can become self-sufficient?
And this brings us to what I think is the most surprising insight. Quantifying non-income labor. If the person who died was the one fixing the leaky tap, mowing the lawn, coordinating all the appointments.
All those jobs. The policy needs to cover the cost of hiring someone to do those things. You're literally putting a dollar figure on the work a partner does. We also have to talk about estate protection. This is where deemed disposition comes in.
The tax man comes calling.
The tax man comes calling. The moment you die, the CRA deems that you sold your assets, like a cottage or a family business. If you don't have cash to pay the capital gains tax, your family might be forced to sell that cottage just to pay the tax bill. Life insurance provides that immediate, tax-free cash.
Okay, let's bring it all back to Derek. His existing $250,000 policy is about to get really expensive. What are his priorities?
Well, he wants to supplement his wife Becky's income until she retires. He wants all debts paid off. And, crucially, he needs separate funds to cover his support obligations to his ex-wife and son to keep Becky out of it.
Then there are final expenses. It's a personal thing, but he estimated about $20,000 for a simple funeral.
And finally, future plans. This is planning beyond just survival. Derek wants to add $10,000 per child for education to supplement their RESPs, and he has a philanthropic goal, a $100,000 bequest to his local hospice.
So when you add it all up, income replacement, debt, support payments, funeral, education, charity.
His existing coverage of $250,000 plus 1x salary, it maybe covers 2 of those 6 priorities. It's completely inadequate.
So we've walked through the full professional checklist, from understanding if your dividends are funding a PUA growth engine to confirming your group conversion lifeline, and then quantifying those ultimate goals, like funding education or a charitable bequest. The full picture needs both the technical details and total clarity on your personal priorities.
You now have the tools that professionals use to evaluate this stuff. And the biggest takeaway is that financial security depends less on rushing out to get a new policy, and far more on critically and honestly answering these questions about what you already have and what your family truly needs.
We focused a lot on replacing income and paying debts. But let's end with one final provocative thought for you to chew on. Think about all the critical, non-financial jobs you do every single day. Who fixes things? Who schedules the appointments and runs the family logistics? The ultimate deep dive is putting a dollar figure on those care duties and all that maintenance, the things you do for free. Because if you were gone, those roles immediately become paid expenses that your family has to cover. What jobs are you currently performing that you need to factor into your final coverage number?